As I've said, you will record it as 50,000 additional shares issued at 4.25 cents per share during the year. Now, please note that these are the most important things. The 50,000 is very important, so you need to include it, and the price per share, which is 4.25 cents. Now, if you are selling 50,000 shares, you are selling them at 4.25. How much did you receive as share capital? So share capital is the money that you receive. You need to remember when you issue shares, the shareholders will have the share as a share certificate, and you will have their money, that is per share. So if one share is 4.25 cents, a shareholder will have one share and you'll have 4.25 cents. That's what a transaction means. It means that you exchanged something. In this case, you gave the shareholder the share and you received money from the shareholder. Now, that money that you receive from a shareholder, we call it share capital. In this case, you sold 50,000 shares. So the shareholders have 50,000 shares, which is stated in their share certificates. Please note that this is issued to different people. So you'll have different shareholders, but in total, all the shareholders will have 50,000 shares, and you will receive money. The money that you're going to receive from them will be the 50,000 shares multiplied by 4.25 cents, and that will be 212,500. 212,500. I need to take you back to what I said earlier on when I said this transaction was recorded. It means the 807,500 includes this 212,500. Okay, it is included in there, and the 190,000 also includes the 50,000. But now I can't determine right now whether actually, I cannot determine the opening balance right now until I've read all the share transactions. Okay, let me go back to the adjustments. Now, I'm still in the first adjustment. It says on the 30th of June, we have done that already. Okay, it says on the 28th of February 2015. Okay, this is right at the end of the financial year. The company repurchased. Repurchased means we are getting our shares back and we are giving the shareholders their money back. Okay, now we repurchased 10,000 shares from an unsatisfied shareholder. So the shareholder was not happy, and we actually repurchased them for 40,000 rand. Please note that 40,000 rand is the money that we are paying to that shareholder. In exchange, we are getting the 10,000 back. So remember, we have issued 190,000 shares in total. Now we actually getting 10,000 of those shares back. So only around 180,000 shares will now be issued because we are buying them back. Buying them back means money is going out, we are getting the shares back. Okay, meaning that the shareholder will get 40,000, right? And then it says an electronic payment has been made on the 28th of February, but that transaction has not yet reflected in the books. So this transaction was not recorded in the books. First of all, there are three accounts that are affected here. Your ordinary share capital account is affected. So you were supposed to reduce that account at the original cost. Okay, original cost means the original amount of money you received when you sold the 10,000 shares. Okay, so our share capital need to decrease by that value. And I said the correct estimate for determining the original cost of the shares will be calculating the average price per share, which is, I refer to it as APPS, which is average price per share. Okay, so we need to calculate average price per share to determine the original cost of these shares, which is 10,000 shares that we bought back. So we know that our share capital will decrease because remember, share capital is contribution that we receive from the shareholders. In this case, that contribution is decreasing because the shareholder will be receiving their money back and we are simply getting the shares back. Secondly, we need to check if we made a profit or a loss by buying those shares. Now, we will make a loss if we are buying these shares back at a value that is greater than what we actually received, what we originally received when we sold those shares. Okay, and then we also need to look at our bank account. Our bank account will be decreasing because money is going out. When you buy back shares, money will be going out. It will be leaving our bank account. And note that it is not just the bank account that is leaving here, that is decreasing. It will also affect your cash flow statement under financing activities, the repurchase of shares. You only put in the money that you actually paid to get those shares back, which is the 40,000 rand, meaning that your bank must decrease by 40,000 rand, and your cash flow statement under financing activities will have buyback, shares bought back, and in brackets you'll have 40,000 rand because that is a cash outflow. Now, this transaction will have to be recorded first in our ordinary share capital note. Now, before we even continue, please note that I can now determine the opening balance. I can now determine how many shares I had at the beginning of the year and how many shares, how much share capital I had at the beginning of the year, because I know that the next transaction was not recorded. Now, in this case, I know that 190,000 shares were issued in total, meaning at the beginning of the year, I had 140,000 shares. So at the beginning of the year, I have 140,000 shares in issue at the beginning of the year. And our share capital will be the 807,500. You minus the 212,500. It will give me my share capital at the beginning of the year, which is 595,000. Now, the shares that were bought back, okay, were 10,000. I need to record them at the average price per share. How do I get this average price per share? You simply take the share capital that you have as at the date you bought back the shares and the number of shares that you were issued as at the date that you bought the shares. Okay, so now in this case, our ordinary share capital before or at that specific date when we bought back the shares, it was 595,000 plus 212,500. That is our share capital. And our number of shares will be 140,000 plus 50,000 shares. And that will give me my APPS, which is my average price per share of 4 Rand 25 cents. And that will be the original cost, meaning that these shares, when I issued them at 4 Rand 25 cents. And obviously that will give me 43,500. That is the money that I originally received for these shares. Okay, so that will reduce, obviously these shares are bought back. It will reduce my share capital. It will also reduce my shares issued, meaning that they will now join my authorized shares. Okay, as unissued shares, those 10,000 shares. Note that my bank account will also be affected by this. My bank account will decrease by 40,000 because I've paid the 40,000 and they did specify that an EFT payment was made, meaning that my bank account now has 63,080, and I will simply balance this off. At the end of the year, I'll have 180,000 shares that are in issue, and my share capital will be 765,000. Now that's 765,000. Since I've already done with this, it will be recorded in the statement of financial position under shareholders' equity. Note that shareholders' equity is made up of only two things, which is your ordinary share capital as well as your retained income. So my ordinary share capital will simply be that 765,000, and I will just leave it like that. Okay, I'm done with the first transaction. Let us go to the second. Actually, I'm not done with the first transaction. I still need to record the loss of the buyback. Now, the loss of the buyback due to buyback, I've already recorded this. Now, I've got, it's either a profit or loss due to buyback, which will be recorded in my retained income. Note that these shares were bought back at 40,000 rand. So I paid 40,000 rand, but originally for these shares, I actually received 42,500, meaning that I actually paid more than what I initially received. In essence, I actually made a profit from the transaction. So the shareholder is losing 2,500 and I'm gaining that 2,500. Okay, it'll be a profit when money paid is way less than the money originally received. Okay, this will also go to the cash flow statement. I did specify the 40,000 will go to the cash flow statement as an outflow due to buyback, but the profit will be recorded right here in retained income note. Now I am done with adjustment number one. Okay, I'm now done with adjustment number one. Let us go to adjustment number two. What does adjustment number two say? It says that on the 1st of March, which is the beginning of the financial year, right at the beginning of the financial year, equipment with a cost price of 14,480 was sold. So that is the asset disposal for 5,000 on credit. So we sold this equipment on credit, meaning that whoever we sold that equipment to is now our debtor. The accumulated depreciation on that specific date amounted to 10,640. This is the accumulated depreciation of the asset sold. No entry has been made by the bookkeeper, meaning that the cost price of equipment is simply your it simply includes the cost price of this asset sold, because you were supposed to actually reduce it, but in this case you didn't. It also means that your accumulated depreciation includes that 10,640, and we need to exclude it because this equipment is no more. So the cost price of this equipment must be deducted from the total cost price of all equipment. The same with accumulated depreciation, it must be deducted from the total accumulated depreciation of all equipment, so that we are left with the cost price of the equipment that we still have, and we are left with the accumulated depreciation of the equipment that we still have. Please note that the selling price was 5,000 rand. So we sold this equipment for 5,000 rand. I'm going to start by recording the transaction in the income statement by determining whether I made a profit or if I made a loss. Okay, all these were actually done in the first part of this video. So I know that the cost price of the asset is 14,480. Accumulated depreciation is 10,640, meaning that the carrying value of this asset at the beginning of the year was 3,840. Okay, that is the carrying value. But this asset was actually sold for 5,000. So when you take your selling price, you minus your carrying value, it will give you a profit or a loss. If your selling price is less than the carrying value, it means that you made a loss, because the carrying value, remember, it represents economic benefits. Basically, it's an asset. Now, those economic benefits, when you initially realize them, when you ultimately realize them, you realize that you will only realize 3,840. Okay. However, the economic climate enables you to sell it at a higher price, meaning that you're actually selling it at more than what you expected from selling the asset, making sure that you have a profit of 1,160. That profit will be recorded in my income statement as profit on sale of the asset. It will be 1,160. But please note that this transaction also affects your equipment note, which is note number 3. Okay, it also affects your equipment note, which is note number 3. I'm just going to go to note number 3, and I hope that it will not impact on current year depreciation. This is my note number 3. In my note number 3, I'm simply going to record and under disposal asset carrying value, the carrying value of the asset sold, which was 3,840. You put it in brackets because it has been disposed. Note that you only recorded in note number 3 at carrying value. Profit goes to the income statement. Here, it will be recorded at carrying value. Now, please note that that 5,000 rand that we spoke about actually goes to your trade and other receivables under trade debtors. So we are going to add the 5,000 rand under trade debtors. Okay. Let us go to trade and other receivables. Trade and other receivables, trade debtors, we're going to have 14,960. We add the 5,000, which relates to the sale of this equipment. Now I am done with adjustment number 2. We now go into adjustment number 3, which also touches on depreciation. It tells you that the vehicles are depreciated at 15% on cost, equipment is depreciated at 20% on carrying value. Okay, so all of that will be recorded. Depreciation will be recorded in your income statement or statement of comprehensive income, or statement of profit or loss. It has so many names. And it also impacts on note number 3. Now let's check what's happening here. Okay, so we know that we've got our equipment and we also have our vehicles. The beginning of the financial year is the 1st of March 2014. The end of the financial year will be the 28th of February 2015. At the beginning of the year, we have 114,000. That 114,000, let me just show you quickly where I got it. When you go to your trial balance, you realize that equipment cost price is 114,000. That's where it comes from. So it is your cost price of equipment. So it's the cost price of all the equipment that you have. Okay, so it'll be 114,000. We've also have accumulated depreciation. Obviously, this is the accumulated depreciation of actually, this is the cost price of the equipment that we sold. So we're going to subtract it from 114,000. So we are left with only the cost price of the remaining equipment because the equipment sold, it was sold at the beginning of the year. There's no way we can calculate depreciation on that. We only calculate depreciation on the assets that we currently are using, even if they're idle, as long as we control them and the intention is to use them. It's important for you to calculate depreciation on that asset. Okay. Please note that the cost price will now be 129,520. Accumulated depreciation will be the total accumulated depreciation as it is given in the trial balance of 51,840. You minus the accumulated depreciation of the equipment sold of 10,640. It will give you 41,200, which relates to the equipment that we haven't yet sold. We're still using. So the accumulated depreciation of the equipment we're still using will be 41,200, giving us the carrying value on equipment as 88,320. So this is the carrying value of equipment that we still have, that we're still using, that we intend on using. Therefore, we need to calculate depreciation on that equipment, which will be at 20% for the whole year because we're using it for the whole year. And that will be 17,664. And you realize that I've included it under equipment as depreciation for the year. The depreciation of the equipment sold will not be calculated as that equipment was sold at the beginning of the financial year. It was sold at the beginning of the financial year. That is why we will not have depreciation on that. I'm just going to go to my income statement quickly. And in my income statement, I will simply include the depreciation. Please note that all the other amounts were discussed in the first part of the video. In this case, we're going to have depreciation of 70,664. Please note that we only have two, actually it's 3 assets, but 2 of them are depreciated, which is your vehicle and equipment. Note that land and building will not be depreciated because land and buildings appreciates in value. And if obviously the value of your land and building is less than what is reflected at book value, you're going to realize what we refer to as an impairment, but in this case, or a reversal of revaluation in most cases, because buildings are revalued at a higher price because they appreciate in value. They hardly depreciate, okay, unless the economic climate or circumstances prevail otherwise. Okay, now we're gonna go to vehicles. I'm gonna go back to note number 3 and show you for vehicles, the cost price as given in the trial balance was 250,000. Accumulated depreciation depreciation was 112,500, and I calculated the carrying value of vehicles at the beginning of the year. Please note that even if the depreciation is not a carrying value or diminishing balance method, it is important for you to calculate the carrying value of the asset at the beginning of the year to make sure that your current year depreciation doesn't exceed the carrying value at the beginning of the year. Okay, your current year depreciation must never exceed the carrying value at the beginning of the year. If it exceeds the carrying value at the beginning of the year, let's say our current depreciation, well, depreciation for the current year is 140,000. We're going to limit it to 137,500 minus 1. So we will not recognize 140,000. We'll simply recognize 137,500 minus 1, which is 137,499. That will be our maximum depreciation. So this is important for you to determine the maximum amount of your depreciation that you can recognize in a year. Current year depreciation, obviously, it's calculated on cost price, which is 250,000. That is why my depreciation under vehicles will be 37,500. That amount will also go to my statement of profit or loss, i.e. your income statement, and I'm going to add it there as 37,500, and obviously my total depreciation will be 55,164. Okay, it will be 55,164. So that is transaction number 3. So I'm done with transaction number 3. Let's go to transaction number 4. Transaction number 4 says the account of a debtor S. Smith of 560 must be written off as irrecoverable. That is way easy. You will simply go to your income statement, and in your income statement, you will simply add that 560 to your bad debts, which is 560. You add it. It'll give you 2,988, which is 2,428 plus 560. That 560 also affects your trade debtors. So I'll simply go to my trade debtors, which is note number 5. I am going to minus that 560, meaning that my trade debtors will now be 19,400. I've already scanned my question and I realized there is no transaction that will actually affect my trade debtors. That will be transaction number 4. And then transaction number 5 says provision for bad debts must be adjusted to 4% of trade debtors. I want you to highlight trade debtors. Trade debtors. Trade debtors are simply debtors that we actually sell goods on credit to, normal operating activities. In this case, note that we do have an abnormal debtor here, which is simply our incidental income in essence, which relates to the asset that was sold. So I will simply discuss that right now. Now, our provision for bad debts that is given the trial balance is 628,000. This is under the statement of, it's under the balance sheet section. And then we're going to calculate provision. Now the provision when we calculate it, please note, I'm going to take the 14,916 and then I'm going to subtract my 560. I do not include the 5,000 because the 5,000 relates to a debtor who actually bought equipment, and that is not our trade. Okay, so we only focus on trade debtors. That is why we only took 14,960, we minus 560, we will get 560 relates to a bad debt, obviously from normal trade who didn't pay us, and that will give us 14,400. We multiply that by 4%, it'll give us 576, which is the bad provision for bad debt. Note that provision for bad debt is just an estimate. We are estimating that we will write off 576,000 as our bad debts in the future. Now, making a provision, obviously, the estimated amount that we have already recorded to be reduced. Now, note bad debts is a bad thing. So when your provision for bad debts decreases, it means your future expenses will decrease, which your future expense here will be your bad debt. Now, a reduction of your expense will be income. That is why our provision for bad debts adjustment will be 52, and we're going to record it as income in the income statement. And that is because the amount that we calculated as provision is less than what is given in the trial balance. Note that the one that you calculated is considered to be the accurate one, and that will be the one that you actually record in your books. It will be 576, making your net trade debtors to be 19,400 minus 576, actually not 776, it's 576. It'll give you 18,824. Note that that income that which is calculated of 52 rands will be recorded in our income statement. It will be recorded in our income statement. We're going to record it in our income statement as income. And we will, please guys, don't just write provision for bad debts. You need to include the surname, which is adjustment. It's provision for bad debts adjustment. Don't forget to write that adjustment, because when you write provision for bad debts, that's another account which will be recorded in trade and other receivables, as I've shown you. So that will be a foreign item, and you will get a minus mark if you include it here. The 52 rand will simply be your profit, and that's what you're going to get. I also included something on the right that I didn't discuss on. No current year depreciation on this asset, which was sold at the beginning of the financial year, because it was sold at the beginning of the financial year. I think I did discuss it. I just wanted to put ink to that. Okay, let us go to the next transaction. The next transaction is about stock, okay? Physical stock taking on the 28th of February 2015 revealed the following: on hand trading stock will be 69,690. So it simply means when we went to our warehouse to count stock, that's how much stock we found. Okay, so this is accurate. So stationery, that's the stationery we actually found in the warehouse. It means that stationery will be your consumable stores. Consumable stores are simply expenses that we actually consume within the business, like in this case, it relates to stationery, probably it's office stationery and stuff that are intended to be used within the business, but we know that we haven't used 430 of it. Okay, now let us look at this. I'm simply going to take those two amounts, you see, as they are. I'm taking them straight to my inventory note, and I will simply record them as that, because those are accurate amounts. Okay, that's what we have on here. That's what we have counted, and we're going to get 70,120. Because I'm closing that inventory off, I will simply take that 70,120 straight to my statement of financial position. It will be recorded under current assets as inventory, and my inventory there will simply be 70,120. Okay, there it is, 70,120. Now we're going to look at the differences between what we have in the trial balance and what we have in the warehouse, and you realize that they are differences, and the differences must actually be recorded. Okay, we're going to start with our trading stock. Okay, please note that in our trial balance, our trading stock was let me just go to it. Our trading stock in the trial balance is 70,846. Okay, but what we counted in the warehouse is 69,696, meaning that what we have in the warehouse is way less than what we have in the books, meaning that our asset inventory in the books must go down, and the reduction in asset is bad news, because assets simply represent future economic benefits. So it is bad news, because it means we cannot get money from that inventory, especially the difference, because we don't have it. How do we sell what we don't have? So that difference must be recorded as a loss, because you're losing, you will not sell it. It's not in the warehouse. So what happened? We don't know. Probably it got damaged. Probably it was stolen. So that loss will be recognized as trading stock deficit. Okay, so it will be recorded recorded in under operating expenses as trading stock deficit. That's why I'm going to have trading stock deficit of the difference, which is 1,156. Do not forget to write the word deficit, because if you put in just trading stock, that's a totally different account. Here is a trading stock deficit, which is a loss, and losses are recognized as expenses. Note that with your stationery as well, you only recognize stationery used as an expense. The unused stationery qualifies to be an asset, which will be used next year. We're going to use that stationery probably to balance our books, and we balance our books, it makes sure that businesses run smoothly. If the businesses run smoothly, it generates profit. So the reason why we actually recognize it as an asset is because it will result in some sort of, it will contribute somehow to us generating income and generating profit. And that is why only stationery used must be an expense. The unused stationery is the one that you need to subtract from your total stationery expense for the whole year, which is 3,500. So you will be left with a stationery that was used, which must be expensed, which is 3,070. Okay, I'm done with that transaction. Let me go to the next transaction. What does the next transaction say? It says rent for March and April 2015 has already been received. And that obviously will go to the statement of comprehensive income, and will go under income. We're going to look at our rent. In this case, our rent in the trial balance is 65,800. Please note that that 65,800 was for 14 months. That's why I simply highlighted it, okay? 65,500, I'm highlighting it. It was for 14 months. And we can only recognize income that was earned within 12 months. Income is earned if it falls within the current financial year. And obviously with that 65,800, parts of it do not fall within the current financial year. 2 months to be precise were received for the next financial year, and the 2 months that we received in advance, we'll have to calculate them. So if my monthly rent was X, to get my total rent, I'm going to take that X and multiply it by 14, because I received rent for 14 months. They said I received it for April and for March and April next year, okay? The next current financial, well, which is the next financial year to be precise. Now, when I divide this by 18, it will give me my monthly rent of 4,700, but 2 months of this monthly rent do not fall within the current financial year, and they qualify to be rent received in advance. Rent received in advance will be deducted or subtracted from your rent income, and your rent income is actually 56,400. That income, rent income that you received in advance, will be recorded in trade and other payables as income received in advance. So we're gonna write it as income received in advance of 9,400, which was 4,700, to multiply that by 2. All right, moving right along. To the next transaction. I hope you are noticing that I deal with each transaction, and as I do each transaction, I record it everywhere it needs to be recorded, so that I don't have to go back, okay? And when you go back, that's where you start making mistakes. Transaction A says the fixed deposit was invested on the 1st of May 2014 at an interest rate of 9% per annum. Interest is not capitalized, so we are allowed to have accrued income here, or we can simply have income received in advance. We don't know, but it's impossible for you to receive income in advance from a fixed deposit. Now, this fixed deposit, we've only had it from May. Now, in the current year, it means that we have had this fixed deposit for May, June, July, August, September, October, November, December, January, and February. We've only had it for 10 months. So we need to calculate interest on this fixed deposit for 10 months. And interest on fixed deposit will be recorded at the bottom of your income statement under interest income. So we know that we have had 100,000, which is the value of the fixed deposit that we have in the trial balance. That 100,000 will calculate interest on it at 9% for 10 months, which will give us 7,500. Please note that there was no interest on fixed deposit given in the trial balance, meaning that we haven't actually received the 7,500. So we're going to add it to our interest income because it's income that we have earned. However, we have not yet received it. And for the fact that we have not yet received it, it means that it qualifies to be an accrued income. That's why I'm highlighting it again. It's an accrued income. Accrued income is an asset. It's income that we're going to receive in the future. Money will come in. Okay, ching ching. And obviously, as money comes in, it will be recorded under bank future benefits. Future benefits. Since it's a future benefit, it will be recorded as part of our current asset, which is trade and other receivables. All right, I've already done that. I'm going to do that. So in this case, that is simply explaining what I did earlier. We're going to have an accrued income of 7,500. Okay, the above that I've just shown you right now was simply a calculation of trading stock deficit. I think I did explain it. Just listen to the audio clip when we actually did that transaction earlier on. Okay, so our accrued income will be 7,500. It qualifies to be a current asset. Okay, the next transaction says a loan statement received from second bank reflected a balance of 103. So this is the closing balance that is reflected in the loan statement we're receiving from second bank. And then it says interest is capitalized and the entity makes annual repayments of 20,000. When they say interest is capitalized, it means it's added to the original value of the loan. So you will not have an accrued expense which relates to interest on loan in this case. We make an annual repayments of 20,000 rand. When we make annual repayments of 20,000 rand, it simply means that in that balance of 103, we have already deducted the 20,000 for this year, but next year we're going to make another repayment of 20,000. That is the current portion of the loan. You look at the end of the financial year and you look 12 months into the future. And then when you look 12 months into the future, you realize that there's a repayment that you're going to make towards the loan. That repayment that you're going to make in the next 12 months, it cannot be recognized as a non-current liability because a non-current liability is a liability that lasts for more than 12 months. But that repayment, you're going to pay it within 12 months. It qualifies to be a current liability, and you're going to write it as a current portion of the loan under your current liabilities. Okay, please note that in our trial balance, our loan is simply 93,000 rand. Okay, and the fact that our loan is 93,000 rand, even after making the repayment, it means there was interest. Okay, and I just want to show you guys what we have from second bank. Please note that under second bank, it says the loan second bank, it's 90,000, but note that this is the balance at the end of the year. We've got 90,000 and they've got 103,000. Okay, so 103 minus 90,000 gives you 13,000. The only thing that could result in your loan going up is interest. Okay, so that's why you're gonna have to recognize that interest in it's interest or you taking a new loan, but in this case they did not specify that we took a new loan, so it's basically interest. Okay, it will be recognized and recorded in our statement of comprehensive income as interest expense, but it will be interest expense of 13,000, and that 13,000 rand, I highlighted it because it also qualifies to be an accrued expense. But in this case, because loan is capitalized, that 13,000 rand will be added to the loan amount, which was unnecessary in this case. We were going to add it to 90,000 and we're going to get 103. But in this case, we were given the loan amount, which is 103, which is the balance as per the loan statement. So I'm going to take that loan amount straight to my statement of financial position under current and non-current liabilities. Under non-current liabilities, I will simply have the loan. Okay, I'll come back to it. Okay, I just wanted to do it quickly. Oh, there it is. So I'm gonna have the loan, which will be 103, okay, minus 20,000, or you can simply put it as it is, which is 90,000 plus 13,000 minus 20,000. Please note that the 20,000 qualifies to be the current portion of the loan, which will be recorded under current liabilities, or you can include it under note number 9, but preferably show it on the face um, of your statement of financial position. I'm just highlighting where that 20,000 comes from. We simply took it out of non-current liabilities and we put it under current liabilities. All right, done with that. Okay, number 10 says insurance included. This is, I always say to you guys, accounting is 50% maths and 40% English. And this is one of the things because it says insurance included. Included means it's included. It's there in the insurance amount that we have in the 12 months. And annual means per year. It's for the whole year. So included in the insurance premium, remember it's monthly payments you make towards your insurance company, whoever is insuring you. So we pay them an annual insurance amount of 8,614, but we pay them on the 30th of September 2014. Annual means per year. So it'll cover us from the 30th of September 2014 to the 1st of October 2015. And that creates a problem because we can only recognize insurance expense that falls within the current financial year. So of this 8,640, some of it does not fall within the current financial year. And you only focus on the insurance amount that doesn't fall within the current financial year. So note that it was 8,640, it was paid on the 30th of September. So it'll cover us for October, November, December, January, February, which is 5 months. That is correct. It covers us for that 5 months. Only that 5 months must be recognized as an expense, which is what we've been covered for, okay, in the current financial year. But it will also cover us for the next financial year of which we have paid for it and we are not yet covered. So that one we cannot recognize it as an expense. We need to subtract it from our total insurance expense because they said it was included. So it is included in this insurance amount of 33,600. So 8,640 is in there. It is in that 33,600. So we need to exclude only the portion that doesn't fall within the current financial year, which is, I mean, if you take 12 minus 5, it'll give you 7. 7 months do not fall within the current financial year. So those 7 months, we need to subtract them because they represent a prepaid expense. We're going to subtract them from our insurance expense. So our insurance expense for the current year will be 28,560. The 5,014, because it represents a prepayment. So we will be covered in the future, so we'll be sorted. There won't be any money going out. It will be recorded as a current asset in trade and other receivables, and we're gonna have it there as 5,040. Okay, the next transaction. The next transaction relates to dividends. So the directors declared a final dividend of 65 cents per share. They said nothing about whoever qualifies and doesn't qualify, blah, blah. So we're going to take our closing number of shares. How much do we have as our closing number of shares? Our closing number of shares as per ordinary share capital is 180,000. So we're going to take that 180,000 and simply multiply it by 65. You need to read the sentence carefully because sometimes they will simply say shareholders whose shares were bought back qualify. So it means that you can't take 180,000. You need to take the value before the buyback because the ones that bought back also qualify. So you need to read statements carefully, okay? So those final dividends, obviously we know that final dividends will be recorded in retained income and we're gonna put it as 117,000. So you're gonna add them up and then it'll give you your ordinary share capital. Please note the formula is as follows. Ordinary share capital is simply your interim dividends plus your final dividends. That is the formula. That is your ordinary share capital. That 117,000 that represents your final dividends will be recorded, as a matter of fact, in trade and other payables. We're going to record it in trade and other payables as shareholders for dividends. Okay, we're gonna record it in trade and other payables as shareholders for dividends because we declared. To declare means we made it official, so we created a duty to pay, but we haven't paid it. Okay, so we're gonna pay it in the next financial year. Since we're gonna pay it in the next financial year, it qualifies to be a current liability. All right, that's what it is. I also included my trade creditors because nothing was said about trade creditors. So the balance that we're given in the trial balance was simply a closing value. It gives us our total trade and other payables as 175,536. Actually, I was supposed to have done that after reading the last transaction, but since I've done it already, I'll just transfer that to I'll transfer it to my current liabilities as trade and other payables. There it is, which is 175,536. If I had a bank overdraft, I was going to include it, but in this case, I do not have a bank overdraft. I mean, you saw it was 63,000, so it was still positive, so I will not have a bank overdraft. If I had it, I was going to include it there. Okay, let's go back to our adjustments. Final adjustment says income tax for the year amounted to 42,800. That goes straight to my income statement, and I'm going to include it as income tax. There it is, 42,800. You put it in brackets because it's an expense. However, you also need to check how much you had at SARS income tax in your trial balance, which represents your provisional payments. So your provisional payments, which are on the debit side, will be 82,508. So it means that you paid more than what you were supposed to pay, creating an asset. If you paid more than you were supposed to pay, the difference will be recorded in trade and other receivables as SARS income tax. Okay, so that's why we're going to have 82,508 minus 42,800. So that 39,708, it's simply what we have prepaid to SARS. We paid SARS extra, and obviously our trade and other receivables will be 71 and 72. That's why I simply said I needed to actually close off my trade and other payables after preparing trade and other receivable. I mean, after the last transaction, because I couldn't tell on which way it was going to go. If you have SARS income tax in your trial balance, just know that it represents either what you owe or what SARS owes you. In this case, SARS owed us that amount because those were just prepayments. That was before we calculated our final tax amount. All right. That will go to current assets as simply trade and other receivables. Now that I need to close everything off, I'll just start with my incomes, okay? Start with my income and everything. I'll just add my income. It will give me a total of 57,612. You add it with your gross profit. So other operating income will be added with gross profit of 715,290. It'll give me gross operating income of 772,000. All my expenses, when I add them up, they will give me 624,776. By all my expenses, oh, now it started everything from scratch. And I just wanted it to continue from where I stopped. So my other expenses is simply a sum of all my expenses. Obviously, when you add all these expenses, they will simply give you what I showed you above. Now, when I add all these expenses here, will actually and add it with all these expenses here, I will get the 624,776. You will take 772,000 minus 624,776. It will give me this value here, which is my operating profit. So operating profit will be 148,126. You add it with your interest income. Income is income. You add it. It'll give you 156,126. You minus your interest expense. It'll give you your profit before tax of 142,814. You minus your taxation. It'll give you a profit after tax. That profit after tax goes straight to trading other. Actually, it doesn't go to trade. It actually goes to retained income, and you're going to record it as net profit after tax, which will be 100,014. Your balance at the beginning of the year was simply 380,118. So you're going to add 380,118 with 100,014, and then you add 2,500. You minus dividends on ordinary shares of 202,500. It'll give you the balance at the end of the year of 280,132, which will go to your balance sheet. So in your balance sheet, you're going to record it under capital and reserve, which is your shareholders' equity, and that will be 280,132. So when you add 280,132 with 765,000, it'll give you that 1,045,132. And then obviously here I simply took 175,536. You added with 20,000, it'll simply give you that 195,536. Now when you add all the amounts that are highlighted as bold headings, which is your shareholders' equity, which is 1,045,132. You add it with non-current liabilities of 83,000. You add it with current liabilities. Let me just show you. It's simply this plus that plus that. When you add those, they're supposed to give you that 1,333,668. Okay, which represents my total equity and liability. Okay, I'm simply left with my assets. Now, for me to complete my assets, I just need one more thing, which is my cash and cash equivalents. So my cash and cash equivalents is pretty much completed. I have cash float, which I took from the trial balance. I have petty cash, which I took from the trial balance of 240. It's going to give me my total cash and cash equivalents of, equivalents of 63,820. That 63,820 will be recorded under current assets. So I'm going to have cash and cash equivalents, and the amount will simply be 63,820. And then I'm just going to add everything up. Before I add everything up, I forgot this. From my financial assets, I've got a fixed deposit of 100,000. I hope you remember that. So I'm going to put it as my financial assets. When you add it with that tangible assets of 1,018,656, it'll give me 1,118,656. You're going to add that with your current asset of 70,000. So that's what I'm currently doing right now. Check. It's 1,118,656. You add it with 70,120. Okay, question is, actually, it's not supposed to be 17,120. It was supposed to be a certain amount. I'll correct that. But whatever I'm going to get there, I'm supposed to add it. I'll add it later. Let me just check. It's 123236668. Okay, it's supposed to give me 205. One is 205,012. So not 170, 120. It's supposed to be 205,012. Let me just correct it. Okay, now that it has been corrected, please know that you simply take that 1,118,056, you add it with 205, 205 and 12, and that will give you that 1,323,668. Now that gives you your total assets. Please note that it must be the same as what you get as total equity and liabilities, which will be the same value. If they're not the same, you just know that you made a mistake somewhere. Trust me, even professionals struggle to balance the balance sheet. So if you struggle, it's not something unique. But in your exams, they pretty much make it easy. And hopefully you got it. Yes. If you have any questions, email me. Otherwise, just enjoy your day.